Welcome back to part 4, the last video for chapter 12. We are going to distinguish between short-term and long-term investments, and remember, investments can be debt or stock investments. How we report investments depends on how soon we imagine divesting them. And we are talking about the balance sheet. All investments are assets, and they are recorded on the balance sheet as either current assets or long-term assets. The current assets section, where we have short-term investments, we also call this title marketable securities. That means these are easily sold, and it is the company's intention to convert this security into cash within a year or the operating cycle, whichever is longer. Long-term investments are investments that are intended to be held for greater than a year, and they're not easily marketable. On the income statement, we will see the impact of investments when we have realized and unrealized gains and losses. Now, the normal operating section of the income statement will record such things as sales minus cost of goods sold equals gross margin, selling and general administrative costs, all leading down to that subtotal on the income statement called operating income. After operating income comes this new section called Other Revenue and Gains. And these are areas that are not the company's primary section, primary business. If you're the Starbucks company, your primary business is selling coffee, coffee products, beverages, gifts, even music. If Starbucks starts getting into buying Amazon bonds or Amazon stock, that goes below the line of operating income. Still on the income statement, but it's under the category of other revenue and gains, other expenses or losses. So look at all these accounts we've learned this chapter. 1, 2, 3, 4, 5 revenue accounts, 3 expense accounts. And let's review them. Interest revenue comes from debt investments. Dividend revenue comes from stock investments. Gain on sale of debt investments, gain on sale of stock investments. These two types of gains are what we call realized gains. They are realized because we actually sold them. We received consideration for them in the form of cash. They really happened. We also have unrealized gain income. And remember, that's for those accounts that are not yet sold, but that we are reporting them at fair value. And this is the current adjustment to adjust them to fair value. It is reported on the income statement. And I'm going to talk about kind of an opportunity to sort of manipulate the income statement here in just a minute. But let's talk about the other new accounts, other expenses or losses. Loss on sale of debt investments, loss on sale of stock investments. It is not good enough to say loss on sale of investment. You have to be specific. Is it a debt or a stock? And then, of course, unrealized loss income. These two accounts, unrealized gain income and unrealized loss income, are accounts that are used for short-term investments, and they're categorized as trading securities on the balance sheet. And they have an immediate impact on profit. So let's sit back and think about this. You categorize an investment as a trading security, and your unrealized gains or losses have an immediate effect on profit. You categorize an investment as available for sale security, and you don't touch the income statement until you actually sell that security. So it is safer in terms of profit to categorize all investments as available for sale. But again, this is something that an auditor is going to look at and say, no, you didn't categorize this correctly, or yes, you did categorize this correctly. So let's look at your available for sale securities. Unrealized gains or losses for available for sale securities are reported on the balance sheet in the stockholders' equity section. And this is straight out of your textbook, Wiley Publishers, where you would have common stock, retained earnings, and then underneath here, unrealized loss on available for sale securities. In this case, we wrote the asset down. So let's take a look at a full balance sheet, again out of your textbook. Here are the short-term investments at fair value, $147,000. We're not recording that adjustment, it's all netted here. So we had an original cost plus or minus the market adjustment here. Here we're recording longer-term investments. See, these are current assets. These are longer-term investments. Investments of stock of less than 20%, investments in stock 20 to 50% at equity. And we record those separately. That's the total assets. Thank you. That concludes Chapter 12. Following are the solutions to the course pack problems for Jubilee Farms. Here's the solutions for Jubilee Farms. You've got the 2011 transactions, recognizing the interest, the 2014 transactions, recognizing the gain on sale, and the subsequent recognition of interest. This is for debt investments. And then going back to 2011, showing the market adjustment. Here is the solution to Frank's Produce. Jubilee Farms was about a debt investment. Frank's Produce is about a stock investment. So we have the purchase. And note how I'm putting the description there. It's quite brief, but that would be the expectation on an exam. Recognition of dividends. We sell some of the stock. I think we sold 50% of it. So we prorate that cost. And then we have the subsequent dividend revenue, again only on the remaining 250 shares.